Hello everybody, and thank you for watching this video. In this video, we're going to be going over Chapter 5 in our textbook, which is just a review of financial statements and some ratios. Today, or in the video, we're going to be going over the income statement and balance sheet again, how they're composed, the foundational equations for them, what you might find on them, and then how they're used. Next, we'll be talking about the relationship between the income statement and balance sheet, and I think in a lot of courses, we've kind of almost underplayed the relationship between the two at times. We'll also be talking about the statement of cash flows, how that can be used, what it's used for, what we find on it, and why it's relevant to investors. And then we'll talk about some ratios that are particularly important to our industry, maybe what some investors look at, or what managers should be aware of when they're looking at their own financials, and then we'll talk about maybe some limitations of ratio analysis. Firstly, the income statement. The income statement is a financial statement that provides information about revenues, expenses, and profits for a business over a very specific period of time. This could be a day, a week, a month, or more commonly a quarter. It can be created for individual departments, divisions, or for an entire corporation in which it's shared with potential investors and current shareholders. While the income statement does have revenues on it, the majority of the income statement is actually composed of expenses. While a restaurant or a hotel may have one or two sales lines, they have many more expense lines. On that note, the largest expense typically for a hotel is labor cost. We have the cost of front desk, of concierge, of parking, of service staff, of the cleaners, things like that. These all have together create a very large labor cost. For restaurants, on the other hand, it's usually cost of goods sold, with labor coming in second. Excuse me. The income statement and the expansion of various of hotel chains and new entrants to the market and many different restaurants popping up has led to a special construction for the hospitality industry. So typically speaking, when you're looking at hotel income statements, they all look the same with restaurants. And the reason for that is because they all run off the same uniform system of accounts. So that's essentially just a list of accounts that is consistent from restaurant to restaurant to restaurant, as well as hotel to hotel. We do this for several reasons. A, so we can have a common understanding of what defines each account for issue identification, making transactions more easily posted and ledgered. It also helps investors who are looking at financial statements to decide which hotel to invest in. It's almost like creating a common language of communicating performance from one operation to another. Hotel income statements are a little bit different than restaurant income statements, primarily because of their cost structure. Hotels tend to have higher fixed costs. They also break down the income statement into departments. So each department will show the revenues for the department, the directly allocated expenses for that department, and if you take the sales, subtract the expenses for that department, you get the departmental income, which is also called the contribution margin for that department. We then collapse or take the total of all of those, and it creates the gross profit for the hotel. And while these revenues and expenses and profit can be communicated in a consolidated income statement format, each department has a supporting schedule that provides details on exactly what their revenues and expenses were that contribute towards creating each operating department's income. Restaurants, we also have a uniform system of accounts. It looks a little bit different because we have different costs, but we also have a very different cost structure. For example, hotels are high in fixed costs, and restaurants are high in variable costs. So we have more variable costs than fixed costs. As a result of restaurants having more variable costs than fixed costs, because variable costs a lot of the time are controllable, on restaurant income statements we have what we call cost percentages that show the amount of the cost relative to sales. We do this because then we can compare period to period or even restaurant to restaurant in certain cases. This is where we move on to the balance sheet. The balance sheet is a financial statement that communicates the financial position of an organization at a specific point in time. So to contrast, an income statement covers a period of time, so from the beginning of a quarter to the end, whereas the balance sheet shows the financial position of the firm at the end. There's no uniform system of account for a balance sheet because typically speaking, most balance sheets all look the same. All balance sheets have three categories to them. So they have assets, liabilities, and owner's equity. Everything is listed in liquidity order. So the most liquid assets are mentioned first. In your liability section, the how would I say this? The maturity of debt comes first. So the debt or the amount of money that you owe first are ordered first in liabilities, and then you have owner's equity. The general equation that kind of outlines the balance sheet is that your assets must always be equal to your liabilities plus your owner's equity. This is because your assets are things that the business owns that are of value and produce value for the business in the future. Now, what I want you to take from that definition is that assets are things that the businesses own that have value. So there's value to these assets. Now, it takes value to acquire those assets. So our liabilities are creditors' claims to those assets, and owner's equity is ownership's or the shareholders' claim to those assets. The difference is who essentially or where the money came from to pay for those assets. For example, if you bought a $5,000 convection oven, so you have now a $5,000 asset, okay? If you got a $5,000 bank loan to purchase that asset, your assets would be equal to $5,000, and your liabilities would increase by $5,000 because you took out a bank loan to do that, and the equation would stay in check. However, if you issued more common stock in order to purchase that asset, the $5,000 would come from equity, and the equation would still stay in balance. Assets, some example of some assets we can recall is probably first and foremost cash and cash equivalents. We also have accounts receivable, inventories, and other kinds of receivables, in this case income tax receivable if we have a tax credit. The one thing that I guess the slide here in our textbook reminds us is to always follow conservatism, so the gap that tells us we must record an asset at the historical value and of the lowest cost or market value, whichever one's lowest. That way we're not over overvaluing the value of our assets. Investments such as stocks and bonds in other companies are assets. We call these marketable securities. We can have property, equipment, land, and things like that, although those particular kinds of assets normally lend themselves to hotels more than restaurants, which is why we see the breakup between the two kinds of hospitality businesses cost structure, right? Hotels, you normally own the land and building that they're on, so there's a cost to that, and as such they have those as assets, but restaurants don't. We can also have long-term assets, again, property, equipment, but also intangible things like goodwill. You'll recall that goodwill is the difference in price. Okay, so goodwill is if you paid for an asset over the value of that asset. So if you purchase something for $1,000 and it's only worth $900, the difference between the price paid and the value is the goodwill. Patents and franchise fees can also represent assets because they limit the limit the ability of other businesses to use certain things that are protected. For instance, not trade secrets, but ways of doing things, processes, machinery, not machinery, but like designs for machinery. These things, because they increase the competitive nature of the firm, they're considered to be assets. We also have liabilities. Liabilities are, you can define them in two ways. One, they are creditors' claim to company assets, or they are financial obligations to pay something, right? As such, we can divide our liabilities into two categories: current and non-current. Current liabilities are due usually within 1 year. It's kind of the opposite of liquidity. We list our liabilities in whichever ones are due first. After our current liabilities, we mention our long-term liabilities because those are due in more than 1 year. So these are long-term bank loans, bonds, things like that. However, sometimes liabilities can have a current and long-term portion associated with them. So the example here is that if a firm or a hotel borrows $5 million from the bank, let's say $500,000 is due within 6 months. We understand that there's two portions to this, right? $500,000 is due within 6 months, so this qualifies as being a current portion of a bank loan. And the remaining $4,500,000 would be the long-term bank loan. So there's both a current and long-term portion to debt sometimes. Lastly, we have owner's equity. This is where our common stock lives, our treasury stock, our dividends, and also our retained earnings. Our retained earnings is just a running total of our previous profit. Our retained earnings is not cash. It's just a running total of the value of the income that the company's made, and yeah. Sometimes there's certain things that can affect the value of our assets and liabilities. For assets, this could be bad debts. This could also be depreciation on depreciable assets. But for both assets and liabilities, for any business that is operating outside of the country, there is a foreign exchange rate that could affect the value of them. Here in Canada, we always represent, for a Canadian company, be it a restaurant or a hotel, we always represent our earnings and our financial position in Canadian dollars. So that means we have to change the currency from whatever other currency we're operating in back to Canadian. And as a result of that, sometimes there can be some losses. These are shown as comprehensive income, if it's an income, or a comprehensive loss if we're taking a loss as a result of the exchange rate. All of which will show up on our income statement, but more thoroughly it would show up on our comprehensive income statement. Excuse me. I find a lot of times, even in the past, I think we've kind of downplayed the relationship between the income statement and the balance sheet. They're connected in several important ways. Firstly, assets are used to generate revenue and cash flow. Okay, this is an important relationship to understand because revenue is what gives us profit after we minus all our expenses, and cash flow is really what allows us to continue operations in the future. And then liabilities are also related to expenses. Sometimes, because of accrual accounting, we will incur and report expenses, but we haven't paid for them yet. This creates a financial obligation to pay, which is a liability. And lastly, retained earnings will increase with net income. So net income, of course, is on the income statement, and retained earnings is on the balance sheet. So to increase one, you increase the other, assuming you didn't declare any dividends or dividends that do not take up all of your net income. So performance in one area on your income statement will change and affect items on your balance sheet. So there are some relationships that we need to be cognizant of, especially when we're looking at one or the other. I find people seem to not use balance sheets as much as they should. They seem them to focus primarily on income statements, especially that little number at the bottom, the profit number, without really understanding how those accrued expenses are affecting liabilities and how dividends are affecting retained earnings. The last statement we're going to talk about is the statement of cash flows. The purpose of this statement is to show where cash is coming from and where it's going, or where it went over a particular period of time. So it usually covers the same period of time as the income statement. So to report where our cash came from and where it went, we break up our operation or our firm into three main activities. So this section is broken up into three main activities or sections. The first is operating activities. This is any activities producing or consuming cash through normal day-to-day operations. So this is operating expenses, this is revenues, this is profit, things like that. We also have investing activities. So businesses, just like people, can invest, and they can also invest into assets. They can also invest into other companies, things like that. And then there's financing activities. So financing activities would be things like generating debt from the bank or generating equity from the market. All of these activities, or the cumulative total of the cash generated from all three of these activities added back to your beginning cash from the beginning of the period, always equals the ending cash or the starting cash balance for the new period. Recently, accountants have been thinking about the statement of cash flows, and even investors, and giving it a new importance or a revisited importance, because we've started to realize that, yeah, net income is great to look at, and current and quick ratios are good, and turnover is good, but what is really paying the bills at the places that we want to invest? It's not net income. Net income is the result of paying expenses. However, it's cash flow that pays for expenses. An example I can give you right now is, think about an income statement. Okay, let's say we're going to keep it a fairly simple example just for my discussion purposes here. But let's say there's a business and it's made $100 profit. Okay, so your revenues and minus your expenses equals your profit, and that equals $100. Okay, so we've paid all our bills. This is great. Let's also say that $100 is a good amount of profit for us, right? That we're happy with this. Investors are happy with this. If they looked at this income statement alone, they might invest, right? Because the profit is looking good, right? And that's where investors get their money from, is from the company's profit. However, what if you looked at the cash flow and realized that the amount of cash left over after paying operating activities and consuming cash from investing and generating cash from financing activities, what if the cash flow is actually really low for the company after the period? This might be concerning for any future period, because that's how they pay their expenses. If cash has not increased a lot from one period to another, it might not be terribly concerning, but what if operating activities has consumed cash, investing activities has consumed cash, and financing activities consumed cash? They might have a hard time paying their bills in the future. So it's always a good idea to look at the statement of cash flows as well. I think we kind of just talked about this, so I'm just going to pass on over this one. And now we're going to talk about ratio analysis. A ratio analysis is an extremely important kind of analysis that a lot of different users of accounting information do. For instance, owners want to look at ratios and see how much money they've made. Managers want to see efficiency ratios and see how efficient they've been with their resources. And investors want to know, generally speaking, a combination of both, right? They want to know, is their money safe if it's invested into this business, and are they profitable, right? It's not. Investors want to make a safe but profitable decision, so they have to look at whether the company is efficient, if it's less risky, if it's secure, if it's sustainable, but they also want to know if it's profitable. And how they do that is they compare the ratios of various businesses to other industry averages. But you have to be careful when you're doing this, because generally speaking, the only company you can compare your company to is your company. So if you're comparing your company or a prospective investment company to an industry average, you have to be really careful what segment you're comparing it to, how they're doing their accounting. You want to make sure that you're getting as close to comparing apples to apples as you possibly can. So we have a bunch of different classes of ratios, the first of which is liquidity, or the ability of an organization to meet its current debt or current liabilities. We have turnover ratios, which measures management's effectiveness at managing the company's assets, or the most liquid assets. We also have solvency, which is the ability to meet long-term debt. We have profitability. This is how profitable our business is. We have activity ratios, so it shows the efficiency of our operating performance. And then we have investor ratios. These ratios are of particular importance to outside investors, and this is something that we would look at when making an investment decision into various companies. Firstly, we have our liquidity ratios and working capital. You should be familiar with all of these, so I'm not going to go over the actual formula. You can do that on your own. You might actually already, we've already gone over these at least once in another course. We have the current and quick ratio, measuring the ability of a company to meet its current debt or current liabilities, or the ability to pay their current liabilities. The quick ratio is a bit of a better measure of liquidity than the current, because it measures or includes only the most liquid assets in its calculation. Now, while a hotel's current ratio should be above 1, sometimes in restaurants you do not have to have a current or quick ratio above 1. Reason for that is because our variable costs are so much larger in proportion to the hotels that creates a large amount of payable accounts, which show up on the balance sheet, which increases the amount of current liabilities. So we, as restaurants, are already starting with a much higher level of current liabilities when compared to hotels. So restaurants do not always have to have a current ratio equal to or greater than 1. Here's some turnover ratios. Again, I'm not going to go over the calculations, although they're on here. Our inventory ratio turnover measures our ability to turn over and replenish our inventory. The appropriate number for this ratio really depends on what kind of business you're running. For example, if you're running a restaurant that has high, that you're using primarily extremely perishable products, you would have a higher inventory turnover when compared to a business or a restaurant that uses non-perishables. Asset turnover is the amount of revenue that we generate per dollar of asset. We want to increase this number as much as possible because it shows that we're using our assets to create sales dollars. And that's what assets do. They create value in the future. So if we're using our assets efficiently, we should be creating a higher asset turnover because, again, it's understood as the amount of revenue per dollar of asset. Next, we have solvency. Solvency ratios, again, measure long-term debt or the ability to meet long-term debt. The debt ratio is your debt as a percentage of your total sales, your total assets. This ratio will depend upon which industry we're talking about. For example, hotels run on a high level of debt. As such, this ratio would be a little bit higher, but at the same time, they've used that debt to purchase the assets. So this will be high, but not as restaurant debt ratios will be much lower. We also have debt to equity, so it shows where the financing for assets has come from, or how leveraged a business is. So does it have more debt or does it have more equity? Typically speaking, in hotels, they have really high debt, so they'll have a debt to equity ratio of closer to 1 or over 1. Restaurants, on the other hand, depending on the size of the operation, but will typically speaking have more equity because when people start up their restaurants, they have to they have to show that they've got some skin in the game, but also debt has a cost to it. We also have times interest earned, which is our EBIT or EBITDA divided by our interest expense. This is the amount of times that our EBITDA could cover our interest expense and provides lenders or even management, a theoretical cushion about being able to cover your interest expense. The bank wants to see this number as well. Investors for financing, so the bank or third-party lenders want to see the times interest earned or interest coverage of being at least 1.2 to 1.5. Profit margin is probably one of the most common ratios you'll see. It is your net income divided by your total revenue, or your net income as a relative figure to your sales. Generally speaking, we want this to be as high as humanly possible. We also have return on equity, which is net income divided by shareholder or stockholders' equity. This is of particular importance to a potential shareholder or an investor because it's understood that equity that's secured on the market is invested, because it's financing, invested into different capital projects or different assets, and they want to see that these assets are producing a good return for them, right? This is how your money's being used. You want to see the company use your financing appropriately, right? Well, the performance that you use to measure that is your net income. So again, you want to see your return on equity as high as humanly possible. We have some activity ratios. We have our occupancy percentage. So this is more so used in hotels, but could also be used in restaurants. It really depends on how you want to do it. Occupancy percentage is the amount of room nights for a particular, amount of occupied rooms in a particular night divided by the total amount of rooms in a restaurant. Table turnover is a good number to use in restaurants. It's kind of the same thing. Average daily rate for a hotel is a measure of sales performance. So for any hotel, there's different kinds of rooms. For every different kind of room, there's a whole bunch of different prices. You'll know this by watching a Trivago commercial. If the total revenue is taken and you divide it by the total amount of rooms occupied, it will give you your ADR, which is your average daily rate. Next, we have our RevPAR, or revenue per available room. This is our occupancy multiplied by your average daily rate. The next two, definitely something we've seen before. We've talked about our food cost percentage and our beverage cost percentage quite a bit over the last couple of years. These are both indications of management's efficiency to manage resources, and those resources are both your food and your beverage. Each restaurant is going to have different cost percentages with respect to food and beverage. However, we do have a general rule in the industry, and it's called 30-30-30. Your food cost should be around 30%, your beverage cost should be around 30%, and so should your labor. Some investor ratios that we like to look at before making, an investment decision. First is our PE ratio, or price to earnings. This is the price divided by our net income, and many investors use this as an indication whether they should buy or sell a stock. You want your price to earnings ratio to be high. However, there are certain scenarios, which we'll talk about in the coming weeks, where it may be decreased and would not be terribly concerning. Next, you will want to look at the dividend payout ratio. As investors, we like dividends. It's our money. However, it's important to note that the management team of the company really decides on how much to pay out, if any at all. So our payout ratio is especially important to investors because it's the percentage of earnings, or net income, that is being paid out to shareholders. This is calculated by taking your dividends and dividing it by net income. The other portion of the ratio, or the percentage, is retained in the business through retained earnings and is invested into what we would hope would be profitable projects. Just because, I'm going to insert a disclaimer here. Just because a company has a payout dividend ratio of 0 consistently doesn't mean it's a company you wouldn't want to invest in. For example, Berkshire Hathaway, they have a dividend payout ratio of 0. The philosophy behind it is that the shareholders get value in the appreciation of their stock as a result of good company performance. So keeping to that philosophy, Warren Buffett takes all the earnings or profit of the company and reinvests all of that profit into future earnings for the corporation. Next, we have dividend yield. This is our dividend divided by the market price per share, or the current market price per share. This is not the holding rate for the return of the stock. It is just the, essentially percentage, your dividend percentage as a result of the price that you paid for the stock. This is a good comparable from two similar businesses, right? Between two similar businesses, you would select the one that has the highest dividend yield. Here's where I'm also going to implement a little disclaimer. Ratio analysis, there's not a whole lot of context to numbers, right? We tend to create the context around our, in our minds, but a lot of ratios by themselves are not good or bad, right? You could look at some one ratio and be like, this is bad, but what if the rest are good, right? It's the cumulative effect or the cumulative picture that these ratios paint for you. But on the same time, we're all biased because we take different positions when we're looking at ratios. For example, owners like to see profitability. If they see poor profitability, they might conclude that the business is doing poorly, when in fact it could be doing well with an analysis of a balance sheet. Lenders, on the other hand, want to see that the company is being efficient and that there is profit to be had. However, they don't always look at things like working capital and liquidity, and those are important things to consider as well. Ratios, they give you a picture of a picture of what's going on, but they don't tell you exactly what's going on. The numbers don't anyway. You might understand some of the things that are going on, like you might be able to make a judgment. For example, here you might look at the food cost percentage and go, man, that food cost percentage or food cost is really high. It tells you, the statements and the ratios will tell you the food cost is high, but it won't tell you why. In some cases, however, you can go to the financial statements notes, and there will usually be a detailed description as to why the number is the way it is. In fact, a lot of questions for poor ratios can be found, or explanations for poor ratios can be found in financial statements notes. At the same time, you do have to take these with a bit of caution. While everyone has their own perspective, management surely has their own, and these notes were written from the perspective of management. Anyway, that was just a quick review of financial statements and some ratios. Please watch the video. And at this point, I guess if you're hearing this, you already have. And we'll see you next week when I get back. Thanks. Bye.